If you're tired of seeing your account evaporate with the wrong trading strategies, whether it's day trading, swing trading, or futures trading, I'm going to teach you the most consistent path you can hop on today to have more success in the markets. It took me from being a broke day trader who is punching in every day staring at candlesticks to someone who ended 2025 with only one losing trade. And inside this masterclass, we're going to teach you everything you need to know to be consistent with our option selling system. We're going to teach you the basics, how to set up your account, how to put the right indicators on, how to pick out the right stocks, and how to place my favorite types of trades. I created this course specifically for people who are burned out, exhausted, and frankly fed up with the results for the past couple years. Because if you've been trying day trading and swing trading, you're on the wrong path. And this is a path that I found that completely changed my life. But the way I'm going to teach it to you and the way I've been doing it is an experience level you won't find on the internet. So buckle up, strap in, take some notes. This is a strategy that you should be implementing in 2026 and beyond if you want to have consistency in the markets. You're losing because you're on the wrong team. I'm going to be honest. If you're day trading, the minute you click buy and you have options, you have a 30% win rate. That is the statistic of the option. And if you have a chart pattern, a stock, or a setup that is subpar, guess what? Your win rate's like 10 or even 5%. So your chance of success is like literally nothing. And what this does is it also glues you to your screen every minute of the day, and you have no chance of making money. Your computer, your phone, you're watching the trade hoping, praying it goes in your favor. It's emotional, it's stressful, and it's not fun. I've spent years on this side, and the minute I switched, I realized, well, guess what? The person gambling is beating the money to someone else, and you can be that other person with a 70 to 80% win rate. And again, that doesn't even take into account the chart, the stock, the pattern, because those factors only increase your edge, your win rate, because option selling is your baseline. That 70 to 80% is just the baseline. I've seen 98, 95% win rates with our system over years if done correctly, only using 50 to 30 minutes a week. And I'm going to teach you the mechanical ways of it, how to find the stocks, how to find the entries, how to pick the right options, all of this. This is meant to help you get on the right side faster so that you can stop losing and be more consistent. So let's break this down. Here's what it looks like to use the right strategy from day one. You're going to take your money and you're going to be growing it year over year over year. And it might be small, but 5 years from now, it will be substantial. Because if you don't blow up your account and you stay in the game, it's going to be life-changing money one day. But if you go down the wrong path and you want to day trade and swing trade, every year you're going to restart. You're going to take 6K, blow it up, 6K, blow it up, 6K, blow it up. And the period between you starting and blowing up might vary, and you might think you figured it out, but the gambler always loses, remember. And they're always going to go to zero with emotions, with the entry mismanagement, and the fact that you're having a 5% opportunity to even succeed. So be sure you start off on the right path and make sure you understand what we're going to teach next. What I'm going to teach today is called the capital flywheel. This is option selling on steroids, a way you've never heard it before. Because when people sell an option, they make 1%. When I sell an option, I make 5%. And you're probably wondering, how is that possible? And it's from these 3 simple checks I do before I even put a ticker in my portfolio. I want to make sure it's a stable, good company. I also want to make sure it's in a good trend. And I want to make sure the IV is high enough for me to get paid something decent. And that maximizes my output when I put in money and I get out the right amount. The next thing I do, and I teach everybody on day one, whether they're a coaching student or somebody that just needs help, is to make sure you concentrate your efforts. For example, if you have a $40,000 portfolio, you don't pick out 40 trades that are $1,000 each. What that does is it waters down your results. And unfortunately, if you have 40 trades, you're likely getting into B setups, C setups, or even setups you don't even know why you're in. And at the end of the day, one winning trade from that 40, if it doubled or tripled, it would never pay for the losers, and it would never even make a decent impact in your whole account. So the idea is pick quality and go deep. 3 to 5 trades max, that's 10 to 30% position size, and that's the number one switch I would teach anybody on day one. Here's a simple 3-step framework to make sure you're using the right stocks, because garbage stocks over the long run, bad trends, bad fundamentals, they will not make you money option selling. No matter how profitable this strategy is, the wrong stock doesn't work. So here's 3 ways I validate and use the right stock. I want a big company, 200 billion market cap, or larger, well established, making new all-time highs, that's a key for success. Next, Ripster clouds. We want to visually see a trend, and this is the number one way to do it. I'll show you how to use those on your chart for the weekly. And lastly, high IV. It has to be over 50%. This means when I put in some money, I get a decent paycheck. Not 1% a month, but this pushes me closer to 3 or 5, or even 10 if you find the right tickers. Now let me show you a stock that does not meet this criteria. This is Lucid. Lucid is a stock that has the bear trends. You can see bear cloud on the weekly chart, but also if we pull up the actual numbers of the company on TradingView, the market cap is too small. Too small is a gamble. We don't want to mess with a stock that's too small like that. Well-established companies are the number one way to succeed with option selling. Lastly, I will always check the IV. Even though this has high IV, we consider this a premium trap because if it doesn't have all three criterias, it's not worth doing with our system. So Lucid, we would avoid this stock. But the number one stock everyone's excited about for the AI revolution is Nvidia. And this has high IV, 34%. That's pretty high for a well-established company. And inside this video, I'm going to show you ways to tune that up to get more out of your Nvidia with one simple switch. But let me show you visually what this looks like. You can see this is a trend. The clouds are bullish, both of them, and the company is 4 trillion, one of the largest companies in history. So betting on the largest company, the best trend, that's how we succeed. And if you start that way, you're going to give yourself a better chance to have a high win rate over the option selling statistic of 80%. Let's go over the Ripster cloud because this is the first validation of you using the system. Basically, if the clouds are bullish, we sell puts. If the clouds are bearish, we take a break. Even on a good stock and a bad trend, you need to avoid option selling because bad trends, stocks falling, they're incredibly risky. And even though there's quality names out there, the trend dictates everything. So first off, we're going to go through how the clouds are created, what these 3 clouds are, and how you can read them. The thing you have to understand is if we go to add the cloud, you type in Ripster on TradingView, and you're going to have to adjust the settings. And it's going to be this EMA cloud from Ripster 47. It's one of the most popular indicators on the internet. If you double click the clouds like I did, you can see you have your EMA 1, EMA 1, EMA 2, EMA 2, and each one has a short and long EMA. So the Ripster cloud is made off of 2 EMAs, exponential moving averages. And what I specifically did with my settings is I turned off cloud 1 and I turned on cloud 4. So we have 3 clouds and each one is made up with 2 exponential moving averages. In the minutes these are stacked bullish, basically the fastest is on top, the slower one's under, that would create a bull cloud. This is your fast cloud, the one closest to price action. It moves the quickest. It has the least amount of moving averages in the equation. So that would be cloud 2, and that has 5 and 12. So those are the 2 combinations of exponential moving averages, and that's the number of candles it averages for each line. And the difference between those 5 and 12 MAs is what makes up the cloud. And visually, this tells us if it's a bullish or bearish trend. We can see the cloud flipped within a couple candles and it became bearish right here. It became bearish right here. And that tells us that flipping, that momentum is shifting, that we're having a bear trend on one simple analysis, the short time frame or the short trend. But we have to take this into account with 3 different Ripster clouds because the fast one dictates something in the short term shifting, but as long as we see health in the long term, that's more important. So when I have these 3 clouds, my simple rule is 2 clouds need to be bullish to consider this a bull trend. So as we can see, the medium and the slow clouds are still bullish, even though there's scenarios where these fast clouds turn bearish. But we can see that the trend is still intact for the most part. So as long as we have 2 clouds in our favor, that's a really healthy sign. And this is a sign of strength and trending. And this is what allows us as option sellers to benefit from the system. Because when we have a stock going up, when you're an option seller, you make your premium faster. Let's say we sell an option that's 30 days out. As long as the trend goes in our favor quickly, we don't have to wait 30 days to collect our money. We might wait 1 or 2. Most of the time when I sell options with our students, we're getting out in a week. We're not waiting 30 days typically. Let me walk you through a recent 2 cloud bearish scenario on MSTR. But I want to point out that this flip where we went from this blue bullish cloud to the yellow bearish cloud recently happened. But over here was the the start of the 3-cloud bull trend. And as you can see, this has been a great run for the stock. And as an option seller, you don't have to have a quality stock to really make money option selling. But the issue is stocks that are not quality, and if you're selling options on them, you're eventually going to get caught holding the bag. So while everyone made money on MSTR, if you got in at the wrong time in the last year, you might be down 60%, which really eliminates all the money you would have made in the last couple years selling puts. So be very careful to just chase trends, chase premiums. Even though bull trends, visually you might see them on the chart with a fun name, over the long run, they're going to crush you. And I want to show you when this move happens. Basically, the fast cloud flips first, goes from green to red. That tells us there's some weakness in the short term. But once we go underneath the medium cloud, underneath the long-term cloud, that also tells us we're going to start pulling all the other clouds into a bearish direction. And you can see right now, about 8 weeks ago, we flipped even the medium cloud from bullish to bearish. And eventually, we're going to flip the long-term cloud from bullish to bearish. And this is all because we're underneath the clouds. And the more time we spend under them, the higher chance we have of turning them around, which is really going to push the stock down and down and down over time, and eventually eliminates us from even having the ability to sell puts. So be very careful using anything that's not a quality name, but just has a quality trend. You need to pair those two together if you want to be truly safe with this over long periods of time. Let's go through put selling terminology so that you can understand everything you need to know to sell your first put option and not be confused with the jargon. Let's simplify it as much as I can. And I'm going to be using the Robinhood option chain here as an example. The first thing you need to understand is the word cash secured. It's probably the most important thing to figure out, because selling put options means you need to have the cash reserved on the sidelines. Because when you sell an option, two things happen at expiration. It expires out of the money, it expires in the money. When it expires in the money, if you're selling puts, you have to convert your cash to shares. And if you hold through the expiration, you wake up on Monday, that conversion happens. And you shouldn't be shocked at that point. So for example, if you sell a put option and it has, let's say, 3 days till expiration, this option here is worth $269. If you sold it, you always get that money. That's the premium. Premium is what you collect as an option seller. You always collect the premium if you were to hold it through expiration. And that is basically just referred to as the price of the option. So as the buyer, you pay that price and you're losing every day gambling. As the seller, you're hopefully collecting that as a credit and you get paid per day from time decay. But that is the one scenario, is basically collecting that. The other scenario from selling options is the assignment for losing stock or getting stock. So this is important. This is called the strike price. The strike price is where you own the shares. So whenever you sell an option, you have to understand that strike price is very, very important. You're basically telling the option chain, telling the markets, I'm okay picking up the stock at this price. Because if we sold a put option at 182, they were still getting the stock at a discount, because right now Nvidia is trading at 184. So we're going to get the stock at a discount if the market falls, but we have to understand we pick it up at that price. And when we hold it through expiration, for example, if we fell to that price, we would wake up in the morning and be owning 100 shares at that price on Monday. And if you're curious what that looks like, you basically need a lot of collateral for that. So just to give you an example, if you just sold one contract, let's go back here at 755, whatever this price is, and this is the 185 example, this is going to require $18,000 of collateral. So collateral is the money you need to have on the sidelines to actually pick up the shares. And if you wanted to go and sell 2 shares, well, you're going to need double that collateral, $37,000. And there's ways to sell options that are cheaper, more cost effective for beginners, but the point is a cash secured put needs to have the cash ready to pick up the shares at all times, or else it's called a naked put, which is where you use margin and you can actually blow up accounts this way. So this 185, you multiply that by 100, and the simple math is that's the money you need on the sidelines. So 2 more zeros, that's $18,500. So that's simple math on collateral. If you go to your broker, be very careful. Some brokers do not calculate collateral correctly. So always make sure you do it, or you use tools to find where your collateral is, like on OptionStrap. So that is cash secured puts in a nutshell. And when you sell the put option, you're going to have some factors you need to decide. So let's walk through the premium, the strike, the expiration next. Basically, premium again is on this column, you always collect that if you were to hold through expiration, basically hold to the last day. The expiration date's up here. This is how much time you have to make your decisions. There's a couple decisions you're going to make when you sell an option, and we can go through those in a second. But that's the time to make a decision before that last day, and the decisions are pretty much set at the end of it. If you were to hold through expiration, you have minimal decisions to make. It's either going to go to cash on Monday, you can reuse that cash for another put, or it's going to go to stock. So those decisions we'll talk about in a second. So premium, expiration, and then strike. You're pretty much trying to line up the strike you're fine owning it at, and a strike that makes sense, that gives you enough money to make it worth your while to put your cash on the line. For example, do you want to put $15,000 on the line to make 40 bucks in 20 days? 15 grand to make 50 bucks does not make sense. I personally want to target 5% a month. So I want to look for a play that can make me off of 15K, like 700. So it's going to be something maybe at the money for this, but this is the wrong stock to use. This is not enough IV, and you can tell because if you click this open, the implied volatility is 35%. So while it's a safe, stable name, the IV is not high enough, which means hitting that 5%, which I try to do, is not achievable. We need to use another trick I'll teach you in a second. But now let's go on to the outcome after we sell a put, because there's a couple routes I go down. There's a couple routes you can go down, and you might not know these routes are available. The very first route is when you sell a put and you get to expiration, that green line on trading or on Robinhood, that is your line. That is the price of the stock. Anything above that line is considered in the money for puts. Anything below that line is considered out of the money for puts. This is important because out of the money options are okay. That means you get all your money, you're out of the play, and you'll wake up on Monday morning after expiration and you won't have to do anything different. You just sell another put option that Monday with your new cash. Most of the time, we do not want to ever hold options till expiration. So a lot of people think that if you sold a 24-day option, you got to wait 24 days to get paid. That's further from the truth. In some cases, I'm selling 90-day out options and I'm getting out in 7 to even 14 days. So even though I'm selling 90 days out, there's a reason to that, but I'm not holding 90 days ever. In fact, the strategy for options that are making money is to get out early and never hold an option selling play through expiration if it's just going to be worthless. It's a waste of your money, and I'll show you why in a second. But now let's talk about in the money. In the money means you have to pick up the shares. You have to take your cash, wake up on Monday, and own with whatever amount of contracts you used. So that short put becomes shares, but you still get the full premium. So whatever premium you sold, you get it, the full thing, which lowers your cost basis a little bit. For example, the 185 put here, this one 94 days out, the premium's 1460, which means your ownership level is 170. So even though your strike is 185, your place to own the stock is actually a lot lower if you include that premium, because you're always going to get it if you were to get assigned. And now there's some things that you can do before expiration which you really need to be aware of. This can help you maximize your income, and these are some of the tricks I've learned. For example, if you're losing and your option is in the money and you're like, I don't want to own the shares, I don't want to get the stock, I just want to be in a place to make money with my cash. Well, that's fine. If you're nervous and you don't like where you're at, I suggest rolling. Rolling an option is just a simple move to de-risk and get your strike lower. For example, let's say you had an option that's expiring this week and you were at 185 and the price of this stock is 184. So you're pretty much going to have to own those shares, and you got 3 days to go. So you don't have much time to maneuver this play. The best thing to do is to add more time to it. And so what you want to understand is this price here, this is the price it's trading at, 265. Let's say you got in at $400, that was your entry, or maybe you got in at 100, so you're down 160 bucks. Because if you got in at 100, it's trading at 270, you're losing that difference, you're down 170. I look at this price to roll. That's pretty much it. This is the price I need to get in order to roll it to break even or to roll it to make money. So if I roll it 30 days out, that's the standard roll procedure. That means you push your expiration out maybe to February. And that 185 strike now becomes an $800 premium. So you've added $600 more. So you could just roll to the same strike, and even though it's in the money, you're getting a $6 lower entry if you were to get assigned. And mentally, that's safe. Mentally, it's a little bit better. The other route to go down is to push your strike lower to match your premium. So if you want to say, I want to just get out of the money and I want to make sure I can get that same premium, you would push it to the 170 strike. This is a pretty similar premium of $300, similar to the 270, but you're $15 lower on your strikes. So in this case, you're still allowing yourself to collect money as an option seller. Maybe you didn't collect initially the first time you sold it, but you're pushing yourself lower on the strikes. So this is one route to go down in the money and you're nervous. In rolling, pretty simple. You're just trying to match the premium with a further out date. And the further out you go, the easier it is to sell lower and lower and lower. For example, 90 days out, you can sell down to the 145 strike. That's going to be the most similar premium to the one today at 185. So literally $40 lower. Isn't that crazy? So adding more time allows you to get further and further down, which means you can get out of losing trades very easily by selling options and rolling them if they get in a bad place. If you're excited and you're in the money, that's a good place to be. That means you're in a stock you're not afraid of, and that's a stock you need to be selling on. If you're ever nervous, maybe switch your stocks honestly, because you should be excited, and this should mean you pick up the shares. So just keep waiting, push it to expiration, get assigned, try the other side of the wheel. The minute you fudge the assignment and you get out early is when you're leaving money on the table, because the markets go up over time, and owning the stock is where you make the most money, not selling puts. So you need to transition to the other side of the wheel if you want to stay profitable and beat your losers. And then the other thing is closing early is always the goal, right? So if you had a trade that's an option and it's 30 days out or 90 days out, if you could close it in one day and even make a fraction of that premium, that's the goal. So for example, let's say you have this option here, 180 strike, $1,200. That's like a 7% return. Let's say this option dropped in value 50%. You made $600. That's like almost a 5% return, or 3.5. If you could do that in a day and get out, good. You recycle your money, you go to different plays, you go to different stocks, and this is how you can maximize option selling. So the goal, honestly, at the end of the day is to close as soon as you can. You never have to wait till expiration. You never want to collect all your money. Inside our coaching program, we are always closing out trades early. Every single one of these trades, we're looking for a 5% return. Most of the time I close, I get 3, 2, sometimes even 1. But the idea is getting into the next play, getting to cash, being on your toes and waiting for the next opportunity so that you're not always in the markets and subjected to the next big move up or down. And that's where you can get stuck. So this allows you to just transition to cash faster. So when you target 5% on a CSP, you'd be surprised how quickly you can make 2 or 3 if you do it correctly. And inside this masterclass, I do want to show you how to maximize your CSP entries so that you can close out ASAP within 1 to 5 days, which is what we try to do inside the coaching program. Now I want to show you the hack I found years ago to increase my premium option selling and create the flywheel. So the flywheel is basically better entries, better premiums, better stocks. And the first step of this is to convert the stocks you believe in, the strong names we've already outlined, to leveraged ETFs. Leveraged ETFs are basically allowing you to get 2 times, 3 times more premium on the same stock. There is obviously increased risk, so doing it properly, looking at the Ripster clouds, is going to be important. But this is the number one way to increase premiums and hit 5% in a month. You might be thinking, this is so risky, Matt. Why would you ever recommend leveraged ETFs? Well, we could go a full year in 2025 with only 1 losing trade. So we can go 5% in a month most of the time. Only once in a while will we ever have to get assigned. So if you do this properly, there's so many other benefits I'm not even listing that I'll go through that make this not as risky as you really think. But if you want to decrease the risk, it really comes down to making sure the trend is in your favor. Bull trends with this leverage is just a huge benefit. So for example, Tesla, if you like it, you switch to TSLL, 2 times more premium. Nvidia, NVDL, Amazon, AMZU. That's misspelled. But let me show you what that looks like. For example, NVDA, if we sell a put, let's go 30 days out, this is going to be out of the money. Typically, I'd say 75% chance of profit is what I like to sell my statistics at. And this is like a 2% return. So 2% in 30 days. Cool. All we do is we switch this to NVDL, and what happens is mind blowing. Not only is this a little bit cheaper for the smaller accounts, it's $8,000 versus 17. But if I go to that same 30-day out option, let's see if we have it. There it is, February. And I go to that same statistic at 75% return or 75% chance of profit, I could sell down here at the 77 strike. And this is a $200 potential profit. And this only requires $7,000. So if we're looking at that, it's like almost a 4%, 3.5% return. So you've doubled your premium at that point. And to hit the 5% return, you're going to be closer to, let's say, 85, which is still a 64% chance of profit. And if I open this up, you can see the implied volatility has doubled. So instead of 30%, we get to 60. And the safe threshold to option sell is between 40 to 70 in my mind. That's the sweet spot where you're not taking on massive risks. Over 70, you can get into some crazy names, but the benefit is wild here. Let me show you really quick the math. So for NVDL, we sell those 30-day out options and we go down to, let's say, even the 5% move here or the 5% return. This means we can stand a 9% pullback before we even hit our break even. So the more premium, you collect more premium with these leverage ETFs, but what you don't understand is you also increase your distance before you lose money. And this is why I like these so much. And the higher the volatility, the bigger the distance. For example, Tesla's in the 90s for IV and the 5% return is going to be right around 16 for the puts. And the break even is now 18% away. So you can withstand a bigger move before you lose money. And I'm not saying you're gonna lose money. The whole point of what I'm teaching you is it's an anti-loss system. You get assigned stock, you don't take losses. That's why day trading and swing trading are so incredibly hard to be good at. Because if you're wrong initially, which you're gonna be wrong, you're cutting down your count, cutting down your count, cutting down your count. If you're wrong option selling, you're just staying patient and doing covered calls typically. But this move is what I discovered years ago. It's basically a difference maker on everything I know today. I've structured my option selling software to be able to provide me the best tickers, the best analysis, and even rate them from high to low. This is exactly what the system is designed to be right now. What's next is most important. This is the 4 types of trades you're going to do for option selling. I'm going to teach you beginner mode all the way up to advanced mode. The very first thing you need to understand is churning. Churning as much as possible. It involves a really good entry, but it also involves the 30-day expiration. So the monthly churn is where I would say everyone should start. This is typically when you're picking 25 to 35 days out. And if you use the leveraged ETFs I'm showing you, you're targeting about 5% a month. For example, TSLL, if you were to find this today, you're going to go probably the 30 days out here and you're going to look for that 5%er. If you do this properly and you enter at the right time, this is a really solid way to churn. Churn winners within a week, churn winners within 2 weeks. And this is right around there for your 5%, either the 16.5 or the 16. So this only requires less than 2K of collateral, and you're going to put yourself in a place to make maybe a couple $100 a month. And that is the beginner mode. Now let's talk about low risk. You're super nervous. You don't want to learn this and get burned. This is another approach to it. You go short term, 7 to even 15 days out. I think 25 is probably too long, but you're going to target 1% a week. This is a better way to just get in the game and get some wins. Because what happens is your win rate goes up, your chance of profit goes up. For example, if you target the 5% opportunity, you have a 70% chance of making it. 70%. If we decrease the expiration dates, let's say we go 10 days out and we look for a 1% return. This is where you just try to match this number to this number. So that's almost a 2% return. This one's a 1 right there. The 16.5 is a 1. Your chance of profit goes from 70 to 85. And now you put yourself in a place to make a 1% return in a week. So it's a little bit less for the month, but you're going to probably see this make most of the money and decay really quickly within a couple days. So you're not waiting 10 days out. You can churn this a lot faster, just like everything I'm teaching you. But that is the low risk beginner approach. Super beginner, super nerve-wracking type of person. That's where they would go. The other approach is set and forget. Set and forget is where you go 2 to 3 months out and you're looking for 10 to 30%. So again, we're always trying to collect a portion of this money. So if we can get 5 in a month, that's awesome, but we don't have to look at it. We don't have to manage it week to week. These are trades that'll typically take probably 30 days to click off. And if you can push it further, you might hit 7% in a month. But once you extend your expiration, let's say it's 66 days out, we're going to look for this to be a 10 or 15%er. And in this case, we're selling at the money. And this has a lower win rate, but your break even's at 15. Before, your break even was around like 15.5. So your break even to own is actually a lot lower with this, even though you're closer to the price of the stock and you're selling strikes that are a little bit higher than previously. But the point is, when you put this on, you're not going to touch it for a week or 2 weeks or even 3 weeks. It would take a while for this to actually decay in a big way. But once you collect even 5 of the 10 or 10 of the 20, this is where you're going to have a pretty substantial month, right? So I like set and forget long-term option selling because it can bank a lot of premium. In high risk advanced mode, maybe you want to do this, maybe you don't, but this is pretty wild if you do this with confidence and you're okay getting assigned. This is where you're trying to ask for the assignment. You're going to sell short-term at the money, 0-2 strikes, lower sometimes. This is where you're okay owning. Some people are, but if you're okay owning, the game changes completely. Basically, if you go for the next week's expiration, maybe 2 weeks out here, and you sell, let's say at the money, this is a 8% return in 2 weeks. So what I've shown you is 4 types of trades. This one makes 2% probably in 2 weeks. This one makes 1% in 2 weeks, maybe 2 in 2 weeks if you do it twice. This one could make 3% in 2 weeks if it's a good market. Maybe it makes nothing. This could make 8 in 2 weeks. We've tripled or doubled or quadrupled every other strategy's return if we ask for assignment. This is an unlock. Most people don't see this, but when you start becoming the guy that's okay being on the other side of the wheel, getting assigned, owning, it changes the game forever in terms of what you can achieve per month. This is mind-blowing if you do it properly. Now let's walk through how to even set up your broker, put on your first trade, and then manage it. The very first thing you're going to do if you're on Robinhood, click your account, click settings, click investing, and then click get options trading. From here, they're going to ask that you answer questions. You don't have to say you've entered a spread before. That's a level we don't need for options. But from there, it's going to make you fill out information about how much money you make. You don't have to copy my numbers. But this is the most important section if you want to get approved. Basically, you want to make sure you're okay with risk. So your goal is to grow. Your risk tolerance should be high, and they're going to be approving you pretty quickly if you say that. From here, you would fill out this application, accept, and then they're going to approve you pretty quickly. And they're not going to put in spreads, which is cool. You don't need expirations same day. This is for gambling, for day trading. Skip that. So not right now. And then boom, that's all you need to do to get approved on Robinhood, which is kind of mind-blowing how easy it is. So from there, let's say you had your setup trigger, and when we look for the right entry, this is what it looks like. These are the 3 conditions we'll teach any student when they're looking at the markets. They want to be entering on down days. That's pretty much it. All these other ones, forget about. All you need to understand if you want to churn premiums and crush option selling like I have, this is all I do. There's 1 day a week. You get a down day, there's 1 great entry. You need to make sure you're ready for it and you sell on that day. And you could pick any of the 4 trades. Some will pay more than others, but the idea is getting in on the down day is the game changer. So any single stock you have listed, make sure you pick the right ones. Wait for it to be down 5%. And from there, you're allocating a good amount, 25% of your portfolio, maybe 10 if you're nervous, maybe 15, but you need to be deep, right? Because they're mega caps. These are companies that like Soxel will hold multiple different stocks. They're diversified in some ways. So the risk is not there. It's not as risky as you think. So when you have the down day, you got to be heavy. You got to be ready to enter the trade. And we're going to give you the beginner mode. So all we're looking for is the 5% 30-day out CSP. And again, if you have a 100K account, we'll use that as an example, but you're going to use like 25K of collateral. And I'll show you how to calculate it here. But sell, put, you need to click that. 30 days out is right there. And then the 5% is going to be either the 16 or the 16.5. I'll click the 16. And then every contract, just so you know, if we put in 1, we're going to get filled in the middle here. You want to get filled as high as possible, ideally like 110, but the market won't fill you easily high. It'll be easier to get filled lower, but you collect more as an option seller with a bigger number. So I would probably start out at 105 and then drop it to 100 if it doesn't get filled. You can see this is a medium fill likely. Yeah, 100, it's a high likelihood fill. So that's right around a good threshold. So if you click review order, it's going to ask for your collateral. And so you want to make sure you sell the right amount. So if we're looking for 25K, we're probably going to need 12 to 14. And this is again for like a 100K account. This is how much we need. So it's 23 collateral. We could sell 1 more if we needed to, but this would give us $1,400. And this is only 1 position. We want to get 3 positions in per week. So multiply that by 3. That's almost like a $4,000 amount of credit on your account. And you're going to collect half of that usually quickly and then put on the next trade and the next trade and recycle your money through the market oscillation. conditions. But once you enter this, boom, that collateral is on the sidelines, ready to be collected, that trades in. And the very next thing you're going to do is put in an exit order, automate this. You're only going to collect half. Remember, I've been doing this for years. You never want to wait till expiration. My best system, my best strategy involves getting out quickly and recycling the capital to another play. So all these trades you see that are completely green have been exited at 50% collection. So you don't need to wait around. You don't need to put on alerts for when it hits. Just exit the trade with the opposite order. So we're going to go ahead and click buy put. In that same trade, we're just going to buy. So let me see if I can exit. And you could do this from the main screen, but if you click buy put, you go to that same one. And if you got in, remember, if you got in at like 100, you're going to get out at half of that. So whatever contracts you used, make sure this says long put because that's you exiting. You sell to open and then you buy to close. So it has to be a buying order. So remember, buy, you have to click that button before and then the put. If you put this in and it's automatic, it's a lot easier. So 0.5 is where you get out. So you got in at 100, you get out at 0.5. That's half of your entry. And that means you're paying to get out. You're paying 700, but we got in at 14, right? So we got in at 14. That's how much we were looking to collect. And we're going to pay to get out at 7. So this should net us total of 700. And the goal is to get that as quick as possible, take the risk off, get to cash, go to the next play. So you click review order, place it, boom, you wait. And we want to make sure we hit good till cancel. Sorry, that's the one important step because every day all your orders reset, they disappear unless this button's clicked. And we want to make sure this can exit at any point in the next week or two. So good till cancel would mean this order would stay active for the next couple weeks, all the way up to even 90 days. So again, when you press review order, enter, boom, it's ready to go. Let's go over the losing trade framework. Basically, you're going to mess up. You're going to put on too much position on the wrong name. You're going to not recognize the trend in the short term, and you're going to get a sign. That's how the market will oscillate anyways. So here's what you do. Basically, the first question you ask is, do you want to own the stock? If you don't want to own it, you can roll out of a position really easily and avoid the loss. We talked about that earlier in the video. Feel free to rewind and go check out how to roll. You can just take the loss and move on. That's a really good strategy. Instead of bag holding something that might not be a good situation, it tends to get worse. So whatever you see now that's a loss, it can always double or triple just because you're in a bad market, bad trend. But if you do want to own it, perfect. That's where you want to be. You want to get assigned. You always want to test yourself on the other side of the wheel with a portion of your account. Not the whole thing, but just learn how that feels, learn how that works, because that's where the maximization comes in if you do it properly. The next question you ask is, if you do want to own and you are owning, are you at max size? Because a stock that's a discount is an opportunity. And if we have more capital to allocate, perfect. If you're at 30%, don't do anything. If you're less than 30%, you want to be selling more puts on the down days. Same thing we did before, just do it again. That way you lower your cost basis, you get in at a better price, and then you can accumulate something amazing at a really good discount. Let me show you what this looks like. For example, let's say you had a stock at $10 and you got assigned at that price. If it fell to 7 and you sold more puts, and let's say it fell to 5, your initial trade's down 50%. But if you get assigned at 5 and 10 with the same position size, your average is at 7. So the minute you move back up to 10, you're up 30%, 50%. So if you didn't do that move of adding more, you'd be at break even. But if you have conviction and you sell through the pain and you get that cost basis even lower, that's where you can make the most out of this. And I don't even mention what happens if you really hold into a trend, but 50 to 100 or 200% is possible in over 3 to 4 months. So now let's talk about how to hold. Basically, there's beginner, medium, and then advanced mode. Beginner mode is if you're nervous, you just want to get out at break even, just cover instantly. And I'll show you the right covered calls to write, but just get out, because it's still good to learn how covered calls work. But the point is, you're not going to maximize anything being scared. And if you're scared, you're going to be on the low aggression side, just covering to exit. What you want to do is hit more than a CSP. At the end of the day, that's how you maximize everything. So you wait for the stock to appreciate 10%, and then you put on a CSP with the framework I'm going to show you, or a covered call higher to give yourself another 10% to make. And lastly, most aggression is where you just hold longer. You maximize a little bit more of an uptrend. You hit 20 to 30% instead of 10. This allows you to make the most of your other side of the wheel getting collected. In selling covered calls, the exit at these points is key. Exiting quick, exiting with the most premium is the goal. And I'll show you what that looks like whenever you get assigned. Basically, we'll click this off. You're going to sell calls now, and we only want to sell calls 7 to 15 days out. This allows us to get out quick, and if we don't get out, we get a lot of premium, because if you sell even just at the money, you're gonna get 5%, and if you're in a stock that's not doing well, that lowers your cost basis by 5% per week, which means for the whole year 50% possible. So even if you're in a losing play, this can really drop that cost basis. But the key is allowing appreciation to come into play and be part of your game plan as a core focus one day, where appreciation is that 10% push or 20. Push yourself to get the most out of your stock accumulation. And then when you're ready, let's say you hit those thresholds where you've made 10 or 20 or 30% on the other side of the wheel, you sell that call the same exact place. All that does is give you that 5% and then the exit. So a quick exit plus premium, because you're always collecting this premium. You're going to hold through expiration, and you're going to get out if you're above 19. Like let's say you sold the 20, which is a little higher. This is a $40. So that's like 3% in a week. Selling a little bit higher can be a benefit because you get the difference of this price minus this price of more appreciation. So basically that push is going to allow you to get another 5% there plus the 3% there. So just a little bit more on the other side of the wheel. That's how I look at it. You want to figure out ownership, if you want to do that or not, and then maximization with capital allocation. Do we want to push it up? And lastly, what's our game plan for getting this to profit? Do we want to hit a profit? Do we want to maximize it? And then once we hit our goals, we're going to start covering with that framework I showed you. To give you an example of when a trade goes bad for us and our coaching students, we had Tesla get assigned 6 months ago at $12. So $12, we got assigned. It's trading at like 18 now. So if you just held it for 6 months, you would have made a decent chunk. So to be more specific, getting assigned at 12 here, just to here is 50%. So if you're trying to hit 10% with the other side of the wheel, you might be cutting yourself short. If you're trying to hit 20, you might be even cutting yourself short with that. So be sure you push yourself one day to really see what a 3-month hold can do. Maybe do less aggressive covered calls. Maybe wait for them. You got to be doing them on up days as well, the green days, to put them on. But a lot of the plays we've got assigned in the past, minus this hedge here, have been some of the biggest opportunities if we just kept holding. Another one, Soxel at 15. Soxel would be the semiconductors, and it's a 3x ETF, and this is a play that went from $6 at the lows to almost 60 at the highs, but we got assigned at around 15 right here, which means at this point today we're up 200%. So if you sell an option, you make 5% return every month. If you hold the stock, you could be making double. So this is why you have to be really aware of the opportunity and get excited about the other side of the wheel. You might be wondering my daily routine, what I wake up, what I do to find opportunities, and how I keep my win rate around 98% for the past couple years. Basically, I've created tools to make it streamlined and easy for me to find trades, see my risk, figure out what the safest things are. And if I go through the markets, you can see I have mega caps I look at. I have multiple ETFs that, have 50 to 100 stocks. These are some safer ones. So I can decide what amount of risk I want to take. Number one, I can rank the risk relative to each other. So I can see Netflix might be safer than Meta. And I can also get an AI analysis on the top plays of the day. So my software is meant to make option selling simple, but also take the very best opportunities with unique characteristics I don't see myself. Like I might not see one's better than the other personally, but the software allows me to do that. But overall, like I showed you earlier, I just want to find a stock down 5%, right? So that's the first framework anybody should do option selling. You just go check your stocks, what's down 5%. Some of these are close. They're down 3.8, 3.6, 4.2, and they're all safe names I like. Amazon, Meta, UNHG. So I would be able to sell all of these. The question is which one? And that's a harder question to answer on this video. It's going to come down to what's the trend? Where's the daily RSI? Is it a stock I have now? Is it a stock I believe in? Is it a stock that has earnings coming up? So that last factor of which one goes within this list, that's going to be more personal and more dialed into your framework. So you're going to have to develop that over over time. But the point is, we put the ball on the tee, we show you what's there. You have to figure out what's your A+ setup and what's within your entry today that's the safest. So this is what I personally do every day for the students. Every week we put on 2 trades, pretty much rolling off 2 trades for profit every week because of the cadence of the down day entry. And all I do is I use the tools like this to kind of make life easier. But once you're in, you're managing the trade, looking for the 50% exit, and then going to the next one. So it should be pretty simple. I want to show you what this could look like if you did it perfectly for a full year, but also maximize both sides of the wheel. So you sell puts, you own stock, you do covered calls. The full cycle is where the real opportunity lies. And let me show you kind of what happened for me in 2024 and how I flipped from 3 different stocks to maximizing this strategy. So at the time I had 5 stocks on my list. I rinsed and repeated Soxel, Tesla, TNA, a lot of the stocks I still use today. But at one point, one of them became a massive discount, a massive opportunity. And you could see right here, Tesla was trading at $150. This was after like a 2-year bear trend. And from here, I focus all my attention on this. I pretty much use all my capital in one ticker and I balanced all sides of the wheel. I was selling puts, accumulating stock, and I was selling puts and getting premium. Doing both strategically not only allowed me to make consistent option selling premium, but also allowed me to pick up shares and put myself in a position to have a 10 or 20% month. Because if you do the math, taking 150K to 500, that's like a 20% month over month return. 20%. It's crazy. And so when I did the wheel, I was very strategic in how I got assigned. And it's very, very important to understand getting assigned is the opportunity. Because with Tesla, even Tesla, you can make great money wheeling. But I was using TSLL, which is the leveraged Tesla. And you can see this area similar to the area I just showed you, but this last run here from here to here was 130%. So you're wondering how did you make 20% in a month? Well, I spent a couple months sideways accumulating. And then once I accumulated enough shares, that's when the account went vertical. So kind of like in this situation here, flat, boom, big push, right? And so when that happened, I'll be honest, I made a mistake. I stopped using Tesla. I looked for the next cheapest, best ticker, which happened to be Bitcoin. And then the swings were bigger. The portfolio is bigger. Went from 300K to 200K, 300K to 200K. And I based. I did the same thing I'm telling you now. I sold puts until I picked up shares. I kept doing it. And at this point, I had so many shares of leveraged Bitcoin, BITX. And you can say this is luck, but this is just trends. We're just getting into stocks in a bull trend with leverage. So it's not luck at the end of the day, if you analyze it like I'm showing you. But this area is where I've been accumulating Bitcoin at that point. And this last big push took it from $20 to $60. So that was a 200% push. Again, you accumulate, you make premium. Doing both sides of the wheel is so important to transition to later, because that took my account from at the lows, let's say 250 to almost 500. And at that point, I thought, hey, I maximized Bitcoin. Now, the last play, I actually shorted MSTR, which was a wild scenario, but I was using the same option selling system I'm teaching you now, but I was doing it on an inverse, basically making money when a stock dropped, but also selling puts on the inverse. It's a wild thing. You'll have to go back to my older videos to check it out. But that's what happens if you do the wheel the best way, the correct way, where you're not afraid to get assigned. You're focusing a portion of your capital on getting premium, having puts expire worthless, but then a portion of your capital into getting shares. And this is why I showed you 4 different types of puts to sell. And with this year where I made over 300K, I did all 4 of those, but I focused on the accumulation phase more importantly. So now let me give you a 90-day game plan to start your option selling journey and figure out what the next steps are each month of the way. So if you're at 0, this is how you can go from 0 to consistent. Basically, foundation is key. Let's go back on how to set the right foundation. We get our accounts ready for level 2 options. It's the minimum you need to sell puts, and we're not buying options. We're just going to stick to selling. Optional, but preferred, is you paper trade the first 30 days. Basically, get a feel for how to enter, what the spread is like, how to get filled, how to get out, what the oscillations in the market could do for a good trade or a bad trade. And then add your indicators. RSI is going to tell you how aggressive you can be. The Ripster clouds are going to tell you if you have a bull trend. Make sure those are on your chart at all times so that you can see what's happening and you can get used to the analysis that needs to be taken. The 5 levels of RSI, just so you know, the cheaper you get, the more aggressive you can get. And at some point, you're going to be buying options one day, not today, maybe 6 months from now, maybe a year from now, but one day. A low RSI with a quality name is the time you layer on a little bit of risk. But that's also what I've done in the past to accumulate, right? Accumulate stock, sell puts to get the stock. So make sure you have the RSI and you're reading it. Again, these should be weekly, your weekly RSI levels. Those are important to check on the right time frame. And everyone I coach, this is the number one thing. They do this right, they succeed. They do this wrong, they fail. Make sure you select 3 to 5 tickers, the right tickers, right? Garbage tickers, you'll never be profitable. Even if you have a good stretch, you're going to give it all back. The right tickers, the quality tickers, this is the threshold you're going to look at. If you want to do a quick scan, market cap needs to be over X. You want to have PE ratios under this. You want to have gross margins over 20%. That'd be great. You want to have strong revenue growth over the years that the company's been around. This will give you a solid company that's basically been dominating for decades. So think about Tesla, Amazon, Google, Netflix. They all have, Amazon doesn't, but 20% margins for the most part, large market caps, low PEs, and solid growth. So this isn't hard line numbers, but like obviously PE ratios in a high growth sector like semiconductors with NVIDIA, you might be in the 40s, and it's okay. Just make sure you understand which sector you're looking at because it's going to change some of these numbers. But what you're going to do next is find the pairing. You're going to find Tesla, use the leverage ETF, it's available. If you find a semiconductor ETF, maybe you like the index fund for semiconductors, go use the 3X leverage one. If you like the triple Qs, go use the TQQQ. What you're going to do is you're going to find some stocks don't have leveraged ETFs and some stocks do. We can only do the system with leveraged ETFs because large companies, they don't have high IV. And I'll give you an example. LLY is like one of the hottest companies for the next 10 years. This weight loss drug is going to be mass used all around the world, and they are the first to market. Not only that, but they have a whole pipeline of products that they're crushing as well that are diversifying. But when we find a great company like LLY, the only downfall is the implied volatility is 35%. You're just not hitting your 5% a month with that. But you would have guessed it. We do have LLY 2X fund right here. LLYX or ELIL. This one right here will have options to sell. And this will have volatility that is prime for our system. And if you go and you want to sell, let's say a cash secured put, the only thing that will hold you back is the liquidity. If there's not enough buy and sell orders in, you can't get filled in and out, which is tough. So make sure that's another metric you check. After you find your stock, after you find the leverage ETF, you need to make sure you can get filled. So this is a list that I use all the time. You can go ahead, make your own list, find different stocks. I'm sure there's products being created by the week that open up. For example, Airbnb just opened up a leveraged ETF, or ABNG, and I love Airbnb. So once they add the option chain, I'm going to milk that thing next. So once we have our stock, the next thing you do is you add your RSI and your Ripster clouds. Ripster clouds tells you the trend. Want to make sure that we have a bull trend. 2 clouds need to be green, right? So 2 clouds bullish, we sell puts. If any of these stocks you see here do not have 2 clouds bullish on the weekly chart, you would take them out of your watch list, put them on a pause list. Because remember, they can come back and trigger later, but in the short term, some stocks aren't bullish even in a bull market, and they might become that later. And the time to realize that is when the 2 clouds become bullish and flip on the weekly. We don't really care about the daily as much. We're mostly just checking the weekly. And then RSI is going to tell you how to be aggressive, when to accumulate, how much to accumulate. That's the key. So very important when we go and prioritize what we're going to sell for our options. We have to have our clouds bullish. We want to have the priority being the lower RSI play at the time. You can use more capital there. You can get assigned more. You can accumulate more when the RSI is discounting. Tier 2, everything else. If we don't meet these criterias, you put everything in the not yet bucket. If the clouds aren't bullish, wait. If the RSI is too high, wait. It'll trigger later, trust me. But in the short term, it's going to save you by just putting it on the side and not using it. So when you're in your first month and you have your tickers, you have your entries, you're going to paper trade. Remember, your 3 to 5 trades a month should be off those tickers with the strong clouds, and you're just going to use the bread and butter 30 DTE trade, 5%, 30 days out. Eventually, you're going to go in the money, at the money, but that's only later in your career, later in your year if you're a profitable option selling. So make sure you track everything. Track the RSI at your entry, the stock, the option you used, and then track how quickly you closed the day you got in, the day you got out, and the result, because that's going to help you figure out a pattern, and the patterns we can repeat. So you might have different patterns than I, and you might find correlations I don't see. So make sure you're keeping all that data somewhere, and it's something you can't just upload to a journal, because like the clouds and the RSI, those are manual inputs. We need to make sure we have those within our data. So obviously close at 50%. That's the key to recycle your capital. From there, I have a system. You have to build a system. You can't just copy and paste me. Even if you got inside my coaching program, I still want you to make my system yours and adjust it. So make it unique. So once we have everything and you find those correlations, you're just going to make your system and you're going to figure out what the ideal conditions are to do XYZ. And from there, once we have our system, we paper traded for 30 days. Now we can use real money. Some people jump to this. This is fine. People that are okay learning and burning, it's fine. For the most part, you're not going to lose much money selling puts. In a tough market, you could get lessons learned, but we don't have many pullbacks. We don't have many bear markets. So we're never really concerned that the CSPs are going to ever test you and put you in a really bad place where you blow it up. You're not going to blow up your account. You're not going to blow up a single trade very often. Maybe once a year, one ticker is going to get truly tested. For the most part, everything's going to be just cranking like it should. So you can jump to the real trades. You can do the paper trading first. That's a personal decision. And if you were with me, if you're taking my trades in the program, I would just tell you to use real money just so that you can hit your win, hit your goal right away, because I'm vetting every play. I'm doing everything to the T. There's no reason paper trading like my trades. But if you're learning something on your own, that's where paper trading could be better. So once we paper trade, once we place our trades, validate the setup, close the trades, we want to get in a groove where we build momentum, right? So we just want to keep cooking, keep cranking. If you don't hit a 3 or 5% month, something's wrong, right? Your position size is too small. Your tickers were bad. Maybe you need to reanalyze the trends in the RSI to see what type of risk you're playing with. But once you start cooking, you want to build up your size. So as these trades go with your core tickers, and as you have your clouds, and as you have your better RSIs, you want to start increasing how much you put down per trade, going from 10% of the account to 20, maybe 20 to 30. And eventually, if you feel like being a degenerate like me, you can use 60 or 80% in the perfect name at the perfect area. Who knows? But from there, you should be running things consistently by week 8, opening your 3 to 4 positions at once over a 10-day window, and then rotating out of them within 10 days and repeating that 10-day cycle. So make sure you're very patient. You're not skipping weeks. You're putting on trades diligently, and you're looking for the very best entries. So last thing is, like I taught you guys, the next step of the system is figuring out how to get assigned, and doing that where you're not getting nervous. You're not jumping out of the trade when it's not working out quickly. You're going into it more. Assignment is where account growths can look like this. P&Ls can be substantial. You can have your best months triple, quadruple a CSP return, and it can be epic. So you need to figure out that last step, scaling up past just puts. Just puts won't get you to your goals, your big goals. You need to be buying options eventually and buying stock. When you start buying things, that's when you can push things up in a big way. I just want to say congratulations. You finished the masterclass for option selling. Learning the flywheel. This is a system that the 1% know. It took me 5 years to even put this together, and this should help you get on a better path instantly. So your next step is find your stocks, pick your options, understand the unique market conditions today, and start the system. So with this market, if I was to give you trades today, they might be different than the trades I give next week. So there's a certain analysis you have to figure out week to week and adjust. That once you figure it out, once you get in that cadence, you'll be far more successful. Hit your 5% far more consistently. But getting there, getting past paper trading, getting to your first win, getting to a place where you don't get stuck that often, it's tough. And if you want to speed that up, if you want to get on your path to hitting your goal faster, that's why we have a coaching program. We have daily live streams, daily trades. We're adjusting the system to the market condition we're in currently. So this is the number one approach to just seeing it live and being able to take trades with more confidence. Because we have hundreds of traders following us, we're not going to be putting out stuff that's risky. We're not going to be putting out trades that could blow up everyone's account. Think about it. Our success as a business is based off your success. So if you want to succeed in the markets, we are here to make sure you're on a better path than you would be by yourself. So fill out the coaching application in the description. We're going to have the software, the course, the daily live streams for you when you're ready. And this is a plan plan and a path to help everybody learn the flywheel better than a YouTube video, better than on their own. So speed it up with us. We'll see you on the inside, and I'm excited to work with you this year. Peace, everybody.